Good afternoon, everybody. My name's Kim Reynolds. I'm a director here at Vincents in the Tax Consulting Division. And today the webinar that we're presenting is in relation to the new small business tax measures that were announced in the federal budget earlier this year. There's been a lot of talk on the potential application of how these measures work. And so we thought it was, given that the questions that we're getting from both clients and from other advisors as to how they actually operate, we thought it might be timely to go through some of the issues and things that we need to think about before we jump in and just try to take advantage of some of the concessions that have been made available. So essentially, today what we're going to do is go through what is a small business, the measures that were introduced in the federal budget and have since been passed, and the timing of the effect of those measures, and also some practical examples in relation to each of them. Now, as you can appreciate, there's the nature of tax is that there's always complications in how we deal with things, and small business measures are by no means any exception to that. So I guess the first point to raise in relation to this is we need to first understand what is a small business, because these new measures that we're talking about do only apply to small businesses. And as many of you will be aware, a small business is a defined term for tax purposes, and that definition is quite different to what the average man on the street might understand to be a small business. And in order to then apply some of these concessions and take advantage of some of these new measures that have been introduced, you need to satisfy a small business test as well. So exactly what is that, and how do we deal with it? So essentially, a small business test is met by the entity that we're dealing with carrying on a business. And we'll look at some of the indicators of what a business is very shortly. Also needs to have an aggregated turnover of less than $2 million in the year. And aggregated turnover, surprise, surprise, also has a definition that we need to take into account. And that aggregated turnover test can be applied in different ways depending on the circumstances of the entity that we're talking about. And the last point here is that the test includes connected entities and affiliates of the taxpayer that we're talking about. So this is an area that I wanted to place a bit of emphasis on today, because when I get questions from clients and other advisors in relation to, for example, how the new tax rates might work for their particular clients or entities, they're focusing on the entity itself and not necessarily other entities that might exist within the group or other relationships that might exist that can impact on whether these measures can be accessed and whether the entity that we're talking about is a small business. So we'll look at each of these in turn. So the first one is, and the important one of the more important ones, and I guess it's a little bit of a everybody thinks that they know what a business is. The tax office also has a view as to what a business is, and the courts have also formed a view over the years as to what they consider a business to be. Now, as a result of many court cases over many years, the tax office quite helpfully summarised what the courts have identified as indicators of a business in a taxation ruling 1997-11. Now that ruling was actually introduced in the context of, are you carrying on a business of primary production, but it is used quite regularly by advisors and also by the tax office to highlight some of the indicators that need to be on show if an entity is conducting activities that wants to be seen as carrying on a business. So essentially, you know, if you're an advisor and you haven't had a look at this ruling for a little while, I'd suggest it's a good ruling to dig out and just refresh as to what the indicators might be. I was actually in a meeting with the tax office recently, and on a client that wasn't a primary producer, and the tax office pulled out reference to this particular ruling as to why we may or may not be carrying on a business. So it is something that they do refer to, so something we need to keep on top of. So essentially, the activities that the entity needs to be carrying on are, they need to have a significant commercial purpose or character in relation to the activities being conducted. There needs to be more than just an intention of engaging in the activity. There needs to be a purpose of profit and a prospect of profit from the activity that's being undertaken. There needs to be a demonstration of some repetition or regularity of the activity. The scale and size and permanency of the activity will also be taken into account. It's important also to remember that the activity should be carried on in a business-like manner along the way, and consider whether the activity that's being undertaken might be better described as a hobby or some form of recreational activity. The ATO in its ruling also indicates that whether a business plan exists will be a helpful supporting indicator as to whether the business is carrying on. We all know that there's a lot of small businesses that don't necessarily have a documented business plan, so that is can be somewhat challenging when you're trying to provide documentation to support your intentions. But all of these things together need to be considered, not in isolation, but each one of them needs to be looked at in the context of the others to see whether overall there are enough indicators there to demonstrate that there is a business being carried on. And if there's not, what can be done to actually make sure that those can be demonstrated along the way. Now the second point is the $2 million turnover test. Now the aggregated turnover of the entity and its connections and affiliates needs to satisfy at least one of the following tests. It needs to have a $2 million turnover in the year immediately preceding the current year, or in the actual year, or in the what's likely in the current year. So depending on the circumstances of the entity being considered, you need to look at one of these tests, possibly all of them, to see whether you can fit into the criteria. So if you're looking at whether the aggregated turnover for the year, for the current year, is likely to be less than $2 million, then you calculate that on the first day of the year. This method is not available for where the entity has carried on a business in two of the income years preceding this current year, and their turnover was more than $2 million in those years, which seems somewhat logical, I guess. So it's a matter of looking at that $2 million turnover test. The entity's annual turnover or aggregated turnover is made up of the annual turnover, and the annual turnover is actually the total ordinary income in the ordinary course of business. So sometimes we might have situations where the turnover of the entity might include things that are outside the ordinary course of business. There might be a capital gain that's arisen during the year. There might be an insurance claim that's been paid. Can be a number of things that aren't directly related to the business but may be able to be excluded when you're considering what your annual turnover is for a particular entity. The fact that the test refers to the aggregated turnover merely means that it's looking at the turnover of not just the entity that you're considering applying these small business measures to, but also to other entities that might be connected or affiliated with that entity, and we'll talk about those next. So what's a connected entity? Now we sometimes or generally look at the meaning of connected entities and affiliates of entities in the context of the small business CDT concessions. However, these provisions and rules are quite important for assessing whether you're a small business as well. So they're not just for the CGT rules. Whether an entity is connected will depend a lot on control and the relationships between the entities that you're talking about. And that control can be direct or indirect. So in the context of a company, the control might be exercised by a right to distributions of dividends, for example, or voting control. The threshold for companies, partnerships and non-discretionary trusts is a threshold of 40%. So if you have shares in a company or an interest in a partnership in excess of 40%, then you are deemed to be connected with that entity. Once you've exceeded that 40% threshold, then you don't just include 40% of the turnover, for example, in your calculation. You actually have to include 100% of the turnover in there. Same thing for the small business concessions on the maximum net asset value test, etc. So it can be a bit of a nasty one, but it's something to need to get past the threshold test first, and then worry about what's actually in the entity to be dealt with. From a discretionary trust perspective, the situation is different, and there are two ways that an entity can be connected with a discretionary trust. The first one, and probably the easiest one to identify, is a pattern of distributions test. That test is basically looking at the distributions that have been made by the trust to the beneficiaries in the previous 4 years to the year that you're considering. So we're in the 2016 financial year at the moment, so we'd be looking at 12, 13, 14 and 15. Looking at the distributions that have been made by that trust, and any beneficiary that has received 40% or more of a distribution, capital or income from the trust would be considered to be connected with under the pattern of distributions test. The other connected and control test in the context of discretionary trusts is in relation to someone that controls the trust. That in the past has been seen to be an obvious choice. Might have been an appointor of the trust, because the appointor could control and dictate what the trustee did by, I don't like what you're doing today, so I'm going to remove you as trustee. So they've got a position of control. That view came partly from an ATO ID that was issued, I think, back in 2008. The tax office got rid of that ruling or that ID in late 2014. However, it still needs to be considered as to whether an appointer, just by their very nature, maybe not of their ability to remove the trustee, but what other activities that they might be undertaking, what other control they might exert over the trustee that might indicate that the appointer is still a connected person or entity. So, for example, Kim Reynolds is an appointer of the Kim Reynolds Discretionary Trust. I may not get a distribution during the year or in any of the previous years, so therefore I'm not connected from a pattern of distributions test, but I control my trust by dictating what its day-to-day activities are. As the appointer, I might be able to remove a particular trustee that's been appointed along the way. I would still be connected with that discretionary trust by virtue of my relationship with the trust. So it is a bit more subjective than the pattern of distributions testing, so it's something that just needs to be kept in mind, noting also that family relationships and the like don't automatically mean that somebody is connected, or even an affiliate, which we'll go through shortly, but they are looked at a little bit more closely because of the nature of the relationships that exist. So the next one to look at is affiliates. So basically, an affiliate is an individual or a company if that individual or company acts or could reasonably be expected to act in accordance with your directions or wishes, or in concert with you. So, but particularly in relation to the affairs of the business of the individual or company. So the starting point really in this context is to make sure that you've got an individual or a company that you're considering, And secondly, is that individual or company carrying on a business? So, for example, is Kim Reynolds an affiliate of her husband? Not automatically under the current affiliate rules. In the old days, if you were a spouse, then you were an automatic affiliate, but under the current rules, no. But does my husband carry on a business in his own right? No, he doesn't. So therefore, on prima facie, he is not going to be an affiliate of me. There are certain circumstances where there might be assets that are owned by him and used by me that will deem him to be an affiliate for other reasons, but under this primary test, if he's not carrying on a business, then he can't be an affiliate of mine. It is more subjective than the connected entities test. It's important to remember, though, also that you're not an affiliate merely because of a business relationship that you might have. So if you're partners in a partnership or directors of a company, then that doesn't automatically mean that you're going to be an affiliate of another person that's in that entity. So just going through a quick, simple example. If we've got company 1 in isolation here, it appears to satisfy the small business entity test because it carries on a business and has a turnover of $1.7 million, and we'll say that's its annual turnover, and that's all good. We've got company 2 over here, and it has rental properties. Now there's a question of whether company 2 is actually carrying on an activity or a business activity because it's renting properties, or is it more a passive activity? So there's, again, you need to consider what are the indicators of a business as to whether it's really carrying on a business or not. But looking at company 2 in isolation, it has a turnover of $500,000. So if it's carrying on a business, then yes, it would satisfy the criteria. If it's not carrying on a business, then it wouldn't satisfy the criteria of being a small business entity. So they're sitting there minding their own business, and then we dig a little bit deeper and find that A is actually the shareholder of company 1 and company 2. So both companies, by virtue of the connected with tests, are regarded as being connected with each other because they are controlled by the same third person or third entity. So A is connected to company 1, it's also connected to company 2, and therefore company 1 and company 2 are connected. So what does this really mean for our ability to access the small business measures? As I said, company 1 and 2 are connected. If company 2 is not carrying on a business, so it's renting properties, we say it's a passive activity, there are not enough business indicators, then only the turnover of company 1 is counted. Company 1 is a small business because it's got a turnover of under 2 mil. Company 2 is not a small business because it's not carrying on a business at all. Example 2, slightly, same facts. Company 1 and 2 are still connected, but if company 2 is carrying on a business, then the turnovers of both companies are tested. And what that means is that we've got an aggregated turnover of 2.2 million, and neither company will satisfy the small business test, and therefore neither will get access to the small business measures that are available to it under the Tax Acts. So something that needs to be worked through. The connection and affiliate tests, as I said, are some things that don't tend to be looked at quite so closely unless we're talking in the context of the capital gains tax provisions, and something that, given the small business measures that have been introduced this year, we do need to pay a bit more attention to, because it's I guess a potentially easy target from the ATO's perspective to identify whether how we're filling out tax returns, the activities that we're describing in the tax returns, etc., are really business activities or not, and therefore open the can of worms as to whether we're accessing the measures that we should be able to access. So now that we've gone through that, I'll spend the last few minutes talking about, what are these measures that the that the government has introduced, and just touch on some examples of how they operate. So I guess the main ones that have been the topics of discussion have been the tax rate reduction, the 28.5%, the tax discount and offset, which is available to non-corporate entities because the tax rate reduction is only available to corporate entities, the immediate asset write-off changes, and also the immediate deductibility for small business startup expenses that have also been introduced. So there's a lot of hurdles to get through before you actually even get in the front door of whether these measures can be accessed or not. So it's like I said, it's important to actually have a look at those at the outset. So the tax rate reduction, as I said before, it's a small business company tax rate has been reduced from 30% to 28.5%. It commenced on the 1st of July 15, so in the current tax year. The legislation that's been introduced shows that there's no change in the franking rate, so there'll be continued franking of 30%. So depending on how long this reduced tax rate operates for, then we're going to have to start managing franking accounts down the track because we're going to be paying out potentially franking credits at a greater rate than what we're actually receiving them. So we need to manage that along the way. And as I said, it applies to companies, also applies to entities that are taxed in the same way as companies. So but there's probably not many of those in the small business sector in itself. So as a very basic example, company has taxable income of $50,000. The tax payable will reduce from $15,000 to $14,250 based on the slightly lower tax rate. The next measure is in relation to the tax discount and the offset that applies to small business entities other than companies. It only applies to business income, and the measure that's been introduced basically is that you get a discount of tax payable being the lesser of 5% and $1,000 per annum. Now, the entity types that it'll relate to are individuals that are small business entities, partners of partnerships that is an SBE, beneficiaries of an SBE trust who receive distributions, but again remembering it only applies to business income as it flows through these types of entities. And as I said, it applies for the 15-16 year in the same way as the corporate tax rate change does. So an example, please ignore the calculation of tax payable there, we've just simplified it for purposes of the illustration. So we've got an individual that's got a taxable income of $100,000. That includes business income of $50,000. So there's tax payable of $25,000. We work out the percentage of business income, which is 50%. So 50% of the $25,000 tax is $12,500. 5% of that is $625. So because this 5% is less than the $1,000 cap, we're allowed the $625 as the discount, the tax discount. This example here just shows how the cap works. Again, same individual, but their business income is $90,000. Tax payable is still $25,000, 90% business income. So 90% of the tax payable is $22,500. 5% of that is $1,125. But we can only get the lesser of 5% or $1,000, so we get capped at the $1,000 tax discount. The next example, or the next measure that we're talking about is the immediate deduction for an immediate asset deduction or an accelerated deduction. So basically it allows an immediate deduction for newly acquired depreciable assets. Those assets must cost less than $20,000. This replaces the existing asset write-off threshold of $1,000, and the measures also provide that where pool balances are less than $20,000, then they may be written off also. Under the small business entity rules, there are some. There's a 5-year lockout rule where the small businesses previously opted out of the capital allowance provisions, that lockout requirement doesn't apply during this period where this accelerated depreciation deduction is available. So if you have got a client or you're an entity that has been locked out of the SBE capital allowance provisions for some reason, then you may be able to get back in, provided of course you meet the SBE test that I mentioned earlier. So the cost needs to be incurred on or after 7:30 on the I think it was the 12th of May 2015, and may be incurred up to the 30th of June 2017. So essentially it has to be acquired on or after the 12th of May and be first used or installed ready for use on or before the 30th of June 17. So it's going to be important in a similar way to a few years ago for those of you that experienced the investment incentive that was available. Then the timing of when items were acquired and when they were installed ready for use, etc., is going to be quite critical to access this accelerated amount. The legislation does also consider circumstances where an entity might have bought something just prior to the 12th of May and then disposes of it and then reacquires it after the 12th of May just to get into the provisions. That doesn't work, so just be aware of all of those tricky things that people might come up with to try and make an asset a newly acquired asset. The legislation has probably already considered it. So there's just a simple example of how that works. So you get an asset of $19,000 acquired after the relevant date, 100% business use, so there's an allowable deduction. In this situation, the second example here, we've got an asset that cost $40,000, but its business use might only be 40%, which is under the $20,000 threshold, but there is no immediate deduction because we're required to look at the total cost of the asset, not just the business use portion in relation to that asset. But you could actually add it to the pool and deduct it at 15% in that year, so all is not lost. And then just a quick example of the pool balance. If there's a pool balance at 1 July 14 of $17,000, no additions to the pool during the year, then at 30 June 15, then the pool balance can be written off because it's below the $20,000 threshold. So the last item I just wanted to touch on before signing off is the immediate deductibility for small business startup expenses. Now these relate to expenses that we might otherwise treat under what's commonly referred to as black hole or 4880 type deductions. So those certain types of startup costs that would otherwise be deductible over 5 years will be immediately deductible where they're incurred by a small business or an entity that's not a business. Now it's important to remember that these amendments in relation to these startup type expenses don't actually extend the scope of 4880 deductions. They merely bring forward the time at which the amounts are able to be claimed as a deduction. So 4880, the black hole provision itself, is really a provision of last resort. So it's really looking at, is it deductible under any other provision in the Act, or does it form the cost base of an asset under the CGT rules? If it doesn't fit anywhere, it is truly black hole, then you can look at 4880 and see whether a deduction can be claimed over a period of time under the normal rules. But if you're a small business entity, then at the moment, under these new measures, you can get an immediate deduction as well. So yeah, so it's something to keep in mind when we're looking at those deductions going forward, to make sure that we're actually capturing as much as we can and claiming as much as we possibly can from the client's perspective. Okay, so that's the end of today's short presentation. A lot of information to go through in a relatively short period of time, but I guess the takeouts from the session, I think, are really, before jumping into claiming a a 28.5% tax deduction, well, sorry, tax rate for a company, or a discounted tax offset for an entity that's not a company, claiming the $20,000 immediate write-off for assets and the like. Before actually doing that, to go back a step and actually reassess, is the entity that I'm talking about, the taxpayer that I'm talking about, a small business entity in the context of what these rules are. So have I got a business to start with? What is my turnover in the context of the ordinary course of my business? And what other entities might I have to include in this assessment of whether I satisfy the $2 million turnover threshold? Because it's not a good one to get unstuck on, and it does take some analysis sometimes, depending on the size of the group that you're talking about, to make sure that you actually do fall within the rules. Okay, well, thank you very much, everybody, for attending, and if you've got any questions, please feel free to contact us here at Vincents, and I will talk to you later. Thanks very much.